Liquidity equals value. I don't care what your spreadsheet says. I don't care what your appraiser told you. I don't care what you paid for it or what you think it's worth. If you can't convert an asset to cash when you need to, you don't own an asset. You own a liability with a fancy story attached to it. And I've watched more investors get destroyed by liquidity problems than by bad investments. Because here's the dirty secret nobody wants to admit. Most investments look brilliant right up until the moment you need your money back. That's when you find out what you actually own. I've been doing this for over 50 years. I've seen every cycle, every bubble, every crash, every panic. And you know what kills people? It's not being wrong about value. Smart people are wrong about value all the time. Markets are messy, timing is hard, forecasting is mostly guesswork. What kills people is being illiquid when they're wrong, being illiquid when the market turns, being illiquid when their lender calls, being illiquid when they need to meet a margin call or a redemption or a debt payment. Illiquidity turns mistakes into catastrophes. It turns temporary problems into permanent losses. So I'm going to tell you exactly how to identify low liquidity risks before they destroy you. And I'm going to tell you why almost nobody does this correctly. Because everyone's focused on the upside. Everyone's modeling their best case scenario. Everyone's assuming the exit will be there when they need it. And that assumption, that one assumption, has wiped out more wealth than probably any other mistake in investing history. But before I get into the specifics, let me tell you what I see coming that almost nobody is talking about. There's a liquidity crisis building right now in private markets, private equity, venture capital, private credit, real estate funds, all of these illiquid structures that exploded during the zero interest rate era. They're all sitting on portfolios marked at valuations that assume they can exit at prices that no longer exist. And the pressure is building because investors want their money back. Limited partners are not getting distributions. They're getting capital calls. They're getting requests for extensions. They're getting excuses. And at some point, something's going to break. And when it breaks, it's going to be ugly because there's no transparent market. There's no price discovery. There's just a bunch of people pretending everything's fine until it isn't. Now, let me break down how you actually identify liquidity risk before it kills you. And the first thing you need to understand is that liquidity is not binary. It's a spectrum. On one end, you've got cash and treasury bills. On the other end, you've got a private company with no obvious buyer or a commercial real estate property in a declining market or a limited partnership interest that you can't legally sell, and everything else falls somewhere in between. The mistake most people make is they treat everything that's not cash as if it has the same liquidity profile. They put stocks and bonds and real estate and private equity all in the same mental bucket called investments, but they're not the same, not even close. A publicly traded stock that trades millions of shares a day is fundamentally different from a private equity investment with a 7-year lockup. And the difference matters enormously when things go wrong. So the first question you need to ask about any investment is not what's it worth or what's the return. The first question is how quickly can I convert this to cash without taking a massive haircut? And if the answer is anything other than immediately or within days, you need to understand that you're taking liquidity risk, and liquidity risk is real risk. It deserves compensation, it deserves a premium, and most of the time you're not getting adequately compensated for it. Let me give you a framework. When I look at an investment, I'm asking myself 5 specific questions about liquidity, and if I don't like the answers to these questions, I either pass or I demand a much higher return to compensate for the risk I'm taking. Question 1, is there a public market for this asset or something substantially similar? If I own shares in a publicly traded REIT, I can sell them tomorrow. If I own an actual building, I might need 6 months or a year to find a buyer. That's a massive difference in liquidity. And it means the building needs to offer me meaningfully higher returns to justify tying up my capital for that long with that much uncertainty. Question 2, how many potential buyers are there and are they active right now? This is critical. In 2008, the problem wasn't just that real estate prices were falling. The problem was that there were no buyers. The bid disappeared. You couldn't sell at any price because the people who would normally buy were either broke or scared or unable to get financing. And that's when you find out what illiquidity really means. It means you're stuck. You can't exit, you can't pivot, you can't respond to changing conditions. You just have to ride it down and hope you survive. Question 3, what's the transaction cost? Even if you can technically sell something, if the transaction cost is 10 or 15 or 20%, you don't really have liquidity. You have a trap, because now you need the asset to appreciate substantially just to break even on a round trip. This is the problem with a lot of real estate. By the time you pay commissions and closing costs and transfer taxes, you're down 10% before you even start. So you better be really confident about your hold period, because exiting early is economically painful. Question 4, is my ability to exit dependent on a specific buyer or a specific market condition? This is where a lot of private equity investors get killed. They buy a company assuming they'll sell it to a strategic acquirer or take it public in 5 years. But what if the IPO market is closed? What if strategic buyers are retrenching? What if credit markets have tightened and leveraged buyouts are off the table? Now you're stuck holding an asset that might be fundamentally sound but has no exit. And your returns go from great to mediocre or worse because you're stuck in the investment for years longer than you planned. Question 5, am I dependent on the kindness of strangers, or do I control my own destiny? This is about structural liquidity versus market liquidity. If I own a diversified portfolio of publicly traded stocks, I have structural liquidity. I can sell whenever I want, regardless of what any other investor thinks. But if I own a limited partnership interest in a private fund, I have no structural liquidity. I'm dependent on the general partner to give me my money back. And if they don't want to, or if they can't, I'm stuck. That's not an investment. That's a hostage situation. Now let me tell you about the warning signs that liquidity is worse than you think, because liquidity is dynamic. It changes, and it usually deteriorates right when you need it most. That's not an accident. That's how markets work. When everyone wants to sell at the same time, liquidity evaporates. So you need to be looking for early warning signs that liquidity is starting to crack. Warning sign 1, bid-ask spreads are widening. If you're looking at any traded asset and you notice that the spread between what buyers are willing to pay and what sellers are asking for is getting wider, that's a red flag. It means liquidity providers are nervous. They're demanding more compensation for making markets. They're worried about getting stuck with inventory they can't move. This usually happens before a bigger crisis becomes obvious to everyone else. Warning sign 2, trading volume is declining. If an asset that used to trade actively is suddenly trading less, that's a problem. It means marginal buyers are disappearing. It means market depth is shrinking. And it means that if you need to sell a large position, you're going to move the market against yourself. Volume is like oxygen for markets. When it starts to decline, you need to pay attention. Warning sign 3, correlations are increasing. When everything starts moving together, when diversification stops working, that's usually a sign that liquidity is the dominant factor in the market. People aren't making thoughtful decisions about individual securities. They're just selling whatever they can sell to raise cash. And that means liquidity is becoming scarce. And scarce liquidity means you don't want to be a forced seller. Warning sign 4, financing terms are tightening. This is huge and most people miss it. When lenders start requiring more equity, when loan-to-value ratios start coming down, when covenants get stricter, when interest rate spreads start widening, all of that is telling you that the people who provide liquidity to the system are getting nervous. They're pulling back, they're protecting themselves, and if they're protecting themselves, you should be too. Warning sign 5, redemptions or outflows are increasing. If you're in any kind of pooled investment vehicle, and you start seeing redemptions pick up, you need to get out immediately, because once redemptions start, they feed on themselves. Early redeemers get out at fair value. Late redeemers get slaughtered because the fund has to sell its most liquid assets first, leaving an increasingly illiquid and overvalued portfolio behind. This is how funds blow up. This is how gates get imposed. This is how investors lose everything. Now, let me talk about the biggest liquidity trap in the market right now, and this goes back to what I mentioned at the beginning. Private markets have exploded over the last 15 years. Assets under management in private equity, venture capital, private credit, they've gone from maybe $1 trillion to more than 10 trillion. And all of that money is locked up in illiquid structures with no transparent pricing and no obvious exit. The narrative is that private markets offer better returns because they're inefficient and there's an illiquidity premium, and sometimes that's true. But right now what you've got is a bunch of assets that were bought at peak valuations with cheap debt, marked by the general partners at whatever value keeps their carry alive, and held by limited partners who are increasingly desperate for liquidity but have no way to get it. And here's the kicker. The distributions have dried up. For years, private equity funds would return capital to investors by refinancing portfolio companies, taking on more debt, and paying themselves dividends. Or they'd sell companies to other private equity funds in a game of hot potato. But with rates higher and credit tighter and exit multiples lower, that game doesn't work anymore. So now you've got limited partners who committed capital expecting it to come back in 5 to 7 years, and it's been 10 years, and they're still not getting their money back. They're still getting capital calls to support portfolio companies that are struggling. This is a liquidity crisis in slow motion. And the scary part is there's no easy way out, because if these funds start marking their portfolios to realistic values, they blow up their track records and destroy their ability to raise new funds. But if they don't mark them down, they're lying to their investors and building up pressure that's going to explode eventually. And when it explodes, the losses are going to be enormous because the marks were fantasy and the actual values are going to be 50 or 60 cents on the dollar or worse. So if you're invested in private markets, if you've got limited partnership interests, if you've got capital committed to funds, you need to be asking very hard questions right now. You need to be looking at the actual distributions you're receiving, not the paper returns. You need to be looking at whether the fund is generating cash or consuming it. You need to be looking at whether the underlying portfolio companies can service their debt at current rates, because if the answers are bad, you're going to lose money, a lot of money, and you're going to be stuck holding it because you can't get out. Let me contrast that with how I think about liquidity. I am almost always in a position where I can act, where I can respond to opportunity, where I'm not dependent on someone else's timeline or someone else's cooperation. And the way I do that is by maintaining a substantial portion of my portfolio in liquid instruments, cash, publicly traded securities, things I can convert to capital quickly without asking permission. People think that's inefficient. They think I'm leaving money on the table. They think I should be fully invested all the time to maximize returns. But those people don't understand optionality. Being liquid when everyone else is illiquid is enormously valuable. It means I can buy assets from desperate sellers at distressed prices. It means I can move quickly when opportunities emerge. It means I never have to be a forced seller myself. That optionality is worth a huge amount, more than the few percentage points I might give up by holding some cash, because the few percentage points I give up in good times get more than made up for by the massive returns I generate in bad times when I'm one of the few buyers with capital to deploy. This is a lesson most investors learn the hard way. They chase yield, they chase returns, they get fully invested, they use leverage, they tie up their capital in illiquid structures, and then the market turns and they're stuck. They can't exit. They can't raise cash. They get margin calls they can't meet. They get redemption requests they can't honor, and they blow up. Not because their investments were terrible, but because they had no cushion, no flexibility, no liquidity. I've done the opposite my entire career. I keep powder dry. I stay liquid. I wait for opportunity. And when opportunity shows up in the form of distressed sellers who need liquidity, and I'm one of the few people who can provide it, I make outsized returns with limited risk. That's the game. That's how you build wealth that lasts. Now let me give you some tactical advice about how to actually manage liquidity risk in your own portfolio. First, you need to know your liquidity profile. Sit down and categorize every investment you own by how quickly you could convert it to cash. Immediate liquidity is cash and cash equivalents. High liquidity is publicly traded stocks and bonds that trade actively. Medium liquidity is things like real estate or private investments that might take months to sell. Low liquidity is anything with lockups or restrictions or no obvious market. Once you know your profile, you need to decide what's appropriate given your situation. If you're young with a stable income and no near-term capital needs, you can afford to take more illiquidity risk. If you're older or you might need capital for unexpected expenses or opportunities, you need to be more liquid. There's no one-size-fits-all answer, but most people are way too illiquid for their situation. Second, never use leverage against illiquid assets. This is how people get killed. They borrow against real estate or private equity or other illiquid holdings, and then the value drops, or they need to post more collateral, and they can't because the asset is illiquid. And now they're facing forced liquidation at terrible prices. Leverage and illiquidity together are a toxic combination. If you're going to use leverage, use it against liquid assets that you can sell quickly if you need to reduce risk. Third, stress test your liquidity needs. Think about worst case scenarios. What if you lost your job? What if you had a health crisis? What if you needed to post collateral for some reason? What if you had a massive tax bill? Do you have enough liquid resources to handle those situations without having to be a forced seller of illiquid assets at bad prices? If not, you need to restructure. Fourth, be incredibly skeptical of any investment that restricts your ability to exit. Gates, lockups, withdrawal restrictions, these are all red flags. They're there to protect the manager, not to protect you. And they mean that when you most want your money back, when you most need liquidity, you can't get it. The only time I accept those restrictions is if I'm getting paid a substantial premium for giving up that liquidity, and even then I limit how much of my capital I'm willing to lock up. Fifth, always have a plan B for liquidity. If your primary source of liquidity is selling an asset in a normal market, what's your backup plan if the market isn't normal? Do you have credit lines you can draw on? Do you have other assets you can liquidate? Do you have relationships with lenders who would extend credit against your illiquid holdings? You need multiple options because your primary plan is probably going to fail exactly when you need it most. The bottom line is this: liquidity risk is real and it's underpriced. The market does not adequately compensate you for giving up liquidity, and that means most illiquid investments are bad deals. They offer you incrementally higher returns in exchange for dramatically higher risk. And when that risk materializes when you need liquidity and don't have it, the losses are catastrophic. I've built my entire career around understanding this, around staying liquid when others are illiquid, around having capital to deploy when others are desperate for capital, around never being in a position where I have to sell at prices I don't like. And that discipline, that obsession with liquidity has made me more money than any particular investment thesis or market call. So here's what I want you to do. Go look at your portfolio right now. Categorize everything by liquidity. Calculate what percentage of your net worth you could access in a week, in a month, in 6 months. And if you don't like what you see, if you're too illiquid for your situation, fix it. Sell something. Raise cash. Get liquid before you need to be liquid, because once you need it, it's too late. Once you're a forced seller, you've already lost. And understand that we're heading into an environment where liquidity is going to become increasingly scarce and increasingly valuable. Central banks are tightening. Credit is contracting. Risk appetites are declining. The buyers who provided liquidity in the last cycle are pulling back. And that means the illiquidity premium is going to go from underpriced to extremely valuable. The people who are liquid are going to have opportunities they haven't seen in decades. And the people who are illiquid are going to get destroyed. So be liquid, stay liquid, demand liquidity, and never ever give up liquidity unless you're getting paid a fortune for it, because liquidity is not just about accessing your money, it's about having options. It's about being able to respond to opportunity. It's about survival. And in the environment we're heading into, survival is going to separate the winners from the losers more than any other factor. Subscribe to this channel if you want to think like an owner instead of a speculator. Hit the like button if you want to hear uncomfortable truths instead of comfortable narratives. And leave your thoughts in the comments. Tell me if you think I'm wrong about the private markets liquidity crisis. Tell me how you're managing liquidity in your own portfolio. I'll respond honestly, even if the truth is hard to hear, because that's the only way we get better. That's the only way we survive what's coming. Liquidity equals survival, and survival is the only thing that matters when the cycle turns.